Hey, good morning, everybody, and welcome to this Tuesday, April 1st, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again today. We're starting off April in a little bit different position than we started off January. So we know Q1 wasn't a very good quarter. We saw a lot of selling, especially in areas like technology and consumer discretionary. There was a huge advantage in many of the value-oriented areas of the market. Even within consumer stocks, we saw staples significantly outperform discretionary. And part of that was during a period when the market was trying to go higher back in the first half of the first quarter. That historically is the best half of the first quarter. And we tried to go higher. We set our all-time high on February 19th. And then a lot of the warnings that I had talked about starting in late January into early February, I think one of my final warnings was, hey, second half of the first quarter, historically in the last 75 years, has produced half the returns that the first half of the first quarter has produced. So we knew the second half of the quarter can be challenging at times. And that's exactly what we saw. Market under a lot of pressure in the second half of this last quarter. And so we're going to start off the second quarter near some pretty key support levels that we held on Monday. So we closed out the quarter with a nice kick save, if you will. The S&P 500, which had closing support, I believe it was 55.21. And we had an intraday low of 55.03. And we'll take a look in a second, but I believe yesterday's low on the S&P was like 54.84 or something like that. And so we had taken out that low early and then had a big reversal. And, we take a look and say, is that the kind of reversal that, marks a major bottom? It can be, but there were some signals that also suggested that was not the case yesterday. So got a lot to talk about. Go through the market action and kind of see where we stand right now. But let me go ahead and get that all squared away here and ready for you. So here's how we finished yesterday. So we finished with the Dow Jones Industrial Average up 417 points. Seems like a great day, right? Up 1%. S&P 500 up more than 0.5%. That was 31 points. So we got back above 5,600. That was good. Better than being below 5,600. NASDAQ, however, you can see was down a little bit more than 0.1%. That was a lot better than we were early in the session. But still, we saw strength throughout the day in a lot of areas, and it just seemed like the NASDAQ was lagging throughout much of the day. Small caps turned a loss into a gain, just like the Dow and the S&P 500. So that was good. NASDAQ 100. So if we really just specifically look at a lot of those large cap growers, the NASDAQ 100, you can see finished down again. If we just pull that one up, you can see we had a nice rally throughout most of the day, but it was the opening bell and then the selling in the first half hour, which is what we typically see a lot of times in these moves to the downside anytime we're in a downtrend. But in this case, we did rally back. And generally speaking, that is good. I would much rather have a sell-off in the morning and have buying throughout the day than the other way around, than to have a gap up and then see selling all day long. To me, buying all day long, I don't care where it starts from, but buying throughout most of the day, to me, is accumulation, no matter how you slice it. So that is a good thing. That was a positive to take away from yesterday. So what was maybe a negative to take away from yesterday? Well, the negative was the sector leaderboard. I was so busy preparing for our quarterly event. That was our update event that we had for our Market Vision 2025. If you recall, back on the first Saturday of January, I gave my outlook for the year to our members. And I laid out several things, including what I believed was a strong possibility that we would see a correction in 2025. Well, we just had it. S&P 500 was down 10% at one point during the first quarter. And we could pull up all of these here. This is what happened yesterday in terms of sector performance. So let's just look at this for 1 second. But look at staples, up 1.5% yesterday. This is on buying all day long after we were weak in the morning. We were down quite a bit early. And then we made our way all the way back up and finished green on most of our major indices. You can see every sector finished the day yesterday green. But because some of the larger cap names didn't turn green, some of the Mag 7, that's what weighed on something like the NASDAQ 100 or the NASDAQ index in general. But you can see that we were up on every sector. So that's good, right? Well, it is, except when you look and you see Staples as the leader, clear leader, up 1.5%. Look at discretionary, up 0.21%. So yes, we rallied back, but it was just more money rotating into defensive and value-oriented areas. Consumer staples, financials, utilities, energy, materials, real estate, healthcare. Where's commercial or communication services? Where's technology? Where's consumer discretionary? Where's industrials? Oh, here they are. They're at the bottom. So this was not, even though we had the recovery, this was not a return to an all-out aggressive, risk on kind of an environment. This was still very risk off. And that's the problem when you get a move back up like this. This is the wrong kind of rebound. The best thing is when you have selling, when you get close to a bottom and you get a lot of selling and market keeps going lower, but you start seeing some of these aggressive groups during the day actually among the leaders. So you see the market go down, but there's under the surface rotation that's moving back into the risk on areas. Here, it's like the opposite. We're going up, but money is rotating more toward risk off. And that is not what drives bull markets. So I can't look at this and say, hey, that was it. That was the low. It was a double bottom. It was a false breakdown. We went lower than the last low and rallied back. I mean, all that looks good, except the leadership, on the session with the money rotating, back into equities and seeing, having a nice, solid all day trend higher. That's all great. But when you look at the actual, where the strength was, it's hard to get overly excited about that action. Currently, we do have futures down. I was going to give you those numbers just so you can kind of get an idea of what we're looking at here. We've had a lot of gap downs recently. That's been subject of, or has been the subject of something I've been talking about quite a bit of late, which is we seem to be moving more into a manipulative phase in this downtrend. We had a period for over a month, or maybe close to a month, where it was just pure selling. We saw distribution at the opening bell. We saw distribution in the first hour. We saw distribution at noon. We saw distribution in the afternoon. We saw distribution into the close. There was a period where there was consistent selling throughout the trading day. When I start talking about these manipulative periods, what I'm referring to is when we get most of our selling at the opening bell and in the first 30 minutes or even maybe first 90 minutes of trading. Because to me, that's where, number one, we start off with a big gap down when there's almost no liquidity in the market. I mean, try trading a stock like in the first 15 seconds of a trading day. First of all, you're going to see big, wide bid and ask. So you don't know where you're going to get filled. If you put in a market order, if you put in a limit order, you're probably not going to get filled. Market makers they'll work around you. If you put in a market order, you don't know where you're going to get filled because there's wide, bid ask on most stocks. And so, but you're down. Your portfolio is down, but there wasn't any volume really to drive it. It was just market makers setting the opening. Then you get the first 30 minutes or even 45 minutes, maybe even up to 90 minutes, where you and I have to react to the fact that these stocks all of a sudden are taking another big hit. What does that do to us? Most of the time, market's in a downtrend, it's gapping down even further. We're losing more money. I mean, first of all, unless you've sold something in the past, you don't even have the cash to buy anything. And even if you had the cash, are you really psychologically ready to jump into the market when it's in a downtrend and gapping lower? Probably not. The tendency is what it does is it drives us to sell. And so the selling starts with almost no volume. And then we add to it as retail traders, following what is showing up on our screens, which is it looks like a horrible day and we just want to get out. Well, once that phase is done, if market makers are truly accumulating shares for institutional clients, that's when you're going to see better action in the second half of the day. During massive distribution periods, you don't get that recovery late in the day. You just see selling all day long. Over a period of time. I'm not saying they're selling all day long every day. We know, we can go back and look. That wasn't the case. We had days when we were going up, but when you net the entire period together, there was selling throughout the day. And so now we move into what I think, like I said, could be a manipulative type phase where we see more weakness in the morning and more buying in the afternoon. Yesterday, an absolutely perfect example. After I talked about it at Saturday's event, we saw exactly what I was talking about on Monday. We get the gap down. It felt horrible. It was coming off a weekend. Last week, we didn't finish strong. We gapped down on Monday morning. It doesn't feel good. We go down for another 30 minutes, 45 minutes, whatever it was. And then all of a sudden, out of nowhere, here comes all the buyers. It's not retail traders. It's market makers. They're finally actually doing their job. They're providing liquidity. And so they start buying. And when they're ready to start buying to the point where they're going to accumulate shares for institutional clients, they keep buying. I mean, the stocks gap down. They're getting all these stocks cheaper than they were on Friday. Everybody who wants to panic and sell because we're down on Monday, they take advantage of it. That's the way the market works. And this was a big, big feature that I talked about many times back in the middle part of 2022 and was one of the reasons why I called the bottom, because we were seeing the market move to new lows, but it was all gaps and early morning selling. And then we were getting, like we saw yesterday, a lot of buying later in the day and throughout the day. But we also had money rotating back into more aggressive areas. We had other signs that were confirming what we were seeing in terms of manipulation. Right now, I just don't think we have everything coming together yet, which makes me think that we may have another leg down. Whether it's now, whether we bounce off key support, maybe we go up for the next couple of weeks, maybe it's earnings, we got a Fed that can't really determine what's going to happen down the road. Maybe with all this uncertainty over tariffs, maybe many of these companies come out and say essentially the same thing. Maybe they come out with great numbers, but for the next quarter, they might say, we don't know. We don't know how this is all going to impact us. We're withdrawing guidance. And you could see a sell-off as a result of that. Market doesn't like uncertainty. So that's a real possibility going into Q2 earnings, is that we don't get the lift that we normally do from earnings season because the future is still left out there cloudy and uncertain. Very real possibility. And I'm just trying to keep it real. If I think we bottomed, I'll tell you, I think we bottomed. I just think there's too much still out there, and I don't think the market is committing. Like I said, you look at this sector summary I'm showing you right here. This is non-committal to aggressive areas. This is risk off performance. That's not what we want to see. So anyway, one thing I was going to do, and I'll go over the futures here in 1 second. One thing I was going to do, though, was just show you, I could either go back 3 months or I could do a year to date. But here's where we stand year to date. And if you notice, it's kind of interesting. Year to date, we have 7 sectors out of 11 that are up for the year. We just went through horrible stuff. We just had a correction. And yet 7 out of 11 sectors are higher. That's kind of strange, don't you think? Well, 2 of the biggest ones, the biggest one is technology, down 11%. That's more than 30% of the S&P 500. So when that group goes down 11%, you need a lot of strength in other areas to try and hold the market up. And then throw in consumer discretionary being down almost 12%. Those 2 areas probably represent, between 40, 45% of, probably closer to 40. No, I don't know if it's closer to 45. Between 40 and 45% of the S&P 500 are these 2 sectors, which are both down 11, 12% area. So market's going to struggle, and it's probably not going to go higher when you've got that portion of the S&P 500 that weak. And this is the aggressive part of the market. This is the risk on. When these groups lead, That's what's telling us the market is in risk on. It's a risk on environment. When these are lagging, it's a risk off. Clearly, this year has been risk off. And so market's going to have problems rebounding in that environment. We've got to see this change. So let's go over. Let me give you the updated futures because it's 9:15. We got 15 minutes to go till the opening bell. And the diamonds first are down about a little more than 1/3 of 1%. Then we've got the spider, which is down 0.3, 0.3 of 1%. The QQQ down just under 0.3 of 1%. So maybe a little bit of skewing more toward those NASDAQ stocks, which makes a little bit of sense because those stocks were torched on a relative basis yesterday. And then finally, the IWM small cap, that's down 0.15%. So a little bit of weakness, not a lot, but with the way we finished yesterday, I think that I would have maybe been looking for, hey, we got a really strong, after the gap down, we had a really strong day. But we didn't exactly finish on the highs. I know the Russell 2000 came back down off of the highs a little bit right at the close. But I don't know. I mean, I'm still thinking we're setting up for a sell-off. And I'll show you why in just a second. But first, let's look at the S&P 500 on a daily chart. Here is the breakdown I was talking about. So if we zero in down here, you can see a lot of times you'll see bottoms form when you go in just a little bit below the prior low. And that's exactly what we saw here. So that made me feel pretty good. And this reversal, huge hollow candle. I mean, that all looks great. But why wasn't it going into more aggressive areas? Why wasn't it going into areas that's been leading this market lower? That is a problem. At least in my view, it's a problem. So not every bottom is the same. This bottom, in my opinion, we didn't see enough rotation into aggressive areas of the market. So I think that is a red flag that, hey, this may not last. Could we go back up to the 20-day again? Sure. 57.82 is still major price resistance, 57.82 on a closing basis. And we've got the 20-day moving average of 57.13. So we've got our overhead areas to watch clear, crystal clear. In my opinion, those are the two levels. If you want to start talking about going back to all-time highs, you got to talk the talk. You got to get through those two levels. And the 20-day, if we sideways consolidate for a little bit, the 20-day won't be that big a factor anyway. Price resistance is the big number, 57.82. So I don't know, write that number on your forehead or on your computer or something. Don't forget it. 57.82. Anyway, we're at 56.11, so we do have room to the upside. Because of the rally, we do have a little bit of room to the downside. But one of the things that bothers me a little bit, if we pull up a 5-day chart, is we saw a big sell-off on Friday and a gap down. And this is a pattern I see quite often after that. After the gap down, we get the move back up. But what do we have? We still have lower lows and lower highs relative to this day, same as it was versus the prior day, same as it was versus the prior day. So in other words, this downtrend is still alive and kicking. Lower lows, lower highs every day. And sometimes when you get these kinds of days where you gap down and then rally, eventually you just jump right back down and then you get right in the midst of this downtrend and the downtrend continues. So I would still be really careful today. And again, trying to call the market every day is so hard. We could be back up at 5,700. I'm not claiming to have any kind of great insights into what the market's going to do one day or the next. I mean, honestly, yesterday when it gapped down, did I think we were going to rally all day long? Not really. Didn't really expect that. I mean, anytime you gap down, you think there's a chance you can fill the gap. But I mean, we had a chance to do that and roll over, and yet we kept coming back. So that was good. I mean, it was definitely a good day in terms of just looking at the S&P 500. But once again, under the surface, not that great. And we still have these lower lows and lower highs in play. So one way to break the lower high and lower low pattern is for today's high to go up and take out the highs we saw right at the end of the day yesterday. So we got red futures, but where do we go when that bell rings? Do we get another one of these look out below, until 10 o'clock or 11 o'clock in the morning, because that's what happens a lot of times. It's that early morning selling. Market makers, they're like the matadors, just letting the bull go right on through, not stopping anything. I don't know. We'll have to watch and see how it unfolds. But I don't like the way this is set up. I don't like the recovery yesterday. I don't like being below massive resistance, trading below the 20, which is below the 50. I mean, there's a lot not to like right now in the market. But if you want some good news, we're into the second quarter. And the first half of the second quarter is the best half of any quarter outside of the fourth quarter. So if you look at the first, second, and third quarters, the best half quarter is the first half of the second quarter. So that's some good news. Also pointed out last night that consumer sentiment, maybe I can bring that up. I'm trying to think. It was dollar. Dollar cent. No, dollar. Oh, I think it might have been dollar UMC cent. There it is. I don't know. Oh, yeah. No, it's $2. I don't know why it wouldn't give that to me. I've been having so much problem finding that lately. Anyway, take a look at this for a second. I'm going to pull up a monthly chart. This will probably be a little surprising for many of you. I don't care about PPO and the RSI. We'll get rid of that. I don't care about moving averages. Clear all that out. What I want is I want a monthly chart, and I want this thing to go back, I don't care, 50 years. And on the bottom, under price, actually, I'm going to reverse this. I'm going to put in here dollar UMC cent. So that's the University of Michigan consumer sentiment. And we're going to put that in at 1.0. Let's pull this up. And it automatically adjusted this back. I don't know why it does that, but it did. All right, so UMC cent. Now, I want you to notice a few things. The sentiment reading that came out in February was 57 on consumer sentiment. And there are a lot of bearish headlines out there about the consumer sentiment being so weak. And most people probably would think, well, heck, everybody feels horrible about everything. This is not the time you want to be in the market, right? Well, you might want to rethink that statement, because when I annotate this and show you a couple things, like I think it's pretty obvious. If we get down to about 55, 56, somewhere in there, and then the lowest low is around 50. I mean, we've got multiple times where we've gotten down to 50 to 55. And you can see right now we're at 57. So we're right on the heels of that. Now, when we hit 55, I'm going to bring in a vertical line here. And I'm going to put it in green, which usually when I mark something in green, it's bullish. But right about there, we go below 55. Right here, we touch 55. Right here, we're at 55. And then right here, basically, we go to 55. Now, if you notice something about this chart, when sentiment gets down to 50 to 55, and it gets to its ultimate low, and this is going back 50 years. So these are lows that we don't see very often. When we get down here, I want you to look. This happened at the beginning of the 1980s. After all that inflation, everybody was, consumer sentiment was horrific. And we started a 20-year secular bull market from that low. How about 2008? It was at the end of 2008 that sentiment dropped to this historically low level, 55. And 2 months later, we put in a major bottom that ended a secular bear market and began a secular bull market. And then here during the, it did both of these. Then here in 2022, about the same time, I called the bottom in the stock market. And I think I might have talked about this indicator as well back then. But you can see we got down to 50. The lowest reading ever came during our 2022 cyclical bear market, where the Fed finally started raising rates. When they finally started raising rates, that's when sentiment was at its lowest. It was already there before the Fed started to lower rates. The market was starting, did I say started to lower rates? Started to hike rates is what I meant to say. But the market had already priced everything in. Stock market does that. It prices in things ahead of time. And so all of a sudden you started getting a lot of news, rate hikes, sentiment, horrible, worst ever on record. And where were we? We were basically at a market bottom. So now I'm going to ask you the question: how bearish do you want to get with the stock market when we're starting to reach all-time low territory in terms of consumer sentiment? Because I'm showing you a history here where this sentiment reading is giving us the opposite signal. And that's what we talk about with sentiment indicators to begin with. They're contrarian indicators. So when everybody is bearish, think about what Warren Buffett always says. When everybody else is bearish, I want to be bullish. When everybody else is bullish, I want to be bearish. Except I think he uses fearful and greedy or something like that. But essentially, that's what he's talking about. And that's what this chart shows you. Notice what happened when we hit the highest. That's when everybody's euphoric. Man, nothing can go wrong, right? Everybody's on board. Consumer sentiment off the charts positive. You know, we're clapping about everything. Everything's good. You know when that came in? Beginning of 2000, right before the dot-com bubble and the financial crisis. We didn't see another stock market high for 13 years after being that enthusiastic and that feeling that wonderful. So when you look at some of these indicators, you know, keep in mind the media is going to look at this and say, oh my God, consumer sentiment's the worst we've ever seen, or it's approaching worst levels ever. And they're going to make that sound so awful that you're just going to want to say, oh my gosh, get me out of the stock market. I never want to touch it again. And yet, if you look at this chart, that's the time you should be buying with both hands. Everything. Hand over fist, jumping in. You know, I wouldn't encourage borrowing, but, you know, mortgage in your future in the house. That's when you want to be in the market. Again, I got a little carried away. Don't listen to me when I said all that. But no, seriously, when sentiment is so bad that nobody can see the light at the end of the tunnel, the stock market's probably already been ripped apart, or at least it's probably in the process of being ripped apart. 2022, it was being ripped apart. 2011, it had rolled over. We had just come out of this, you know, dot-com bubble, financial crisis, and here we go again, rolling over. Folks couldn't take it. How about midst of that financial crisis? I remember October, November of that year. I thought I had done a great job. I have a little bit of a story here. It's kind of funny. Market's getting ready to open though, so I'll try to make it quick. But I remember it was October 10th of 2008. And I remember back at the end of September, the market was starting to take another downturn. And I had gotten out of just about everything. Well, I thought I had gotten out of everything. And I also thought that, well, not that I thought, I actually had a couple of times traded inverse ETFs. So I was actually making money in a couple of accounts while we were making this move to the downside. But on the morning of October 10th, 2008, I went out to the mailbox and I opened up the mailbox, and what was in there? My third quarter college fund statements for my kids. And I just looked at it and my heart sunk. And I thought, I didn't do anything with those funds. Now you got to keep in mind, the end of September was really bad, but the first 10 days of October, if you go back and look, was like straight down. Like we were probably down more than 10% in those 10 days, maybe might have been 15%. I don't even know. It was straight down. And so I looked at this and I'm just like, oh my gosh. I know that this is not going to be a good statement to begin with, but when I consider what has happened since this statement balance, I mean, it just made me sick to my stomach. And so all of a sudden, my kids weren't going to go to Stanford; they were going to go to a community college. Um, and I kind of chuckle about it today, but I wasn't chuckling back then. But anyway, that was just one thing that happened during that. I just remember that period was so awful for the stock market. I had a buddy of mine who was a CFO in a home building, and also they had a real estate operation as well. And we were sitting at our golf club having lunch. And I remember him telling me that they didn't have the money to cover payroll, and he didn't know if the bank was going to get, if the bank was even going to be able to allow them to have a credit line temporarily to pay the payroll. That's what companies were going through. I mean, it was literally like, I mean, imagine if all the companies around the country can't make payroll. Think about what's going to happen to our financial system. That's how close we were to a complete disaster. But anyway, in the midst of that, that's when we got these readings right before we had this huge move to the upside. But you can see what drives these sentiment feelings. It's the market that starts to roll over and is so horrible. I mean, the 1970s, it wasn't so much the market at that time. It was inflation. It was all the news. It was, just, I think back then we also had the issue with Iran, the hostages. I kind of remember that was like 79 into 80. I could be off. I don't know. I don't remember exactly the dates back then. But anyway, we had a lot of stuff going on, and that was driving consumer sentiment down. And remember, this was at the very end of a secular bear market, much like 2008 and then again 2011. So this was after years and years and years of people being just beaten down, beaten down, beaten down for so many different reasons. And that's what drives the sentiment down there. Folks, we're back down in that category already. And I don't even think the market's been that bad. I mean, we have a correction. Small caps have certainly been worse, down close to a bear market. Some individual stocks have been down bear market territory. Some of the Mag 7 have been beaten up pretty good. But I don't think it's been like what we saw in these other periods yet. We've already got sentiment in this country so weak, believing that nothing can go right. I just think it's really important you keep that right there in mind. I do want to mention too, by the way, that if you are new, please join us over at earningsbeats.com. We have a free 30-day no-cost trial. So you can come in, you do give a credit card, but you can check out everything we do, all of our past videos, a lot of really great information, the chart lists we provide, which are basically watch lists, the guidance every single day, a daily market report, except on Mondays, I give a weekly market report, which is a much bigger view, big picture view of what's going on in the market. So I keep up to date with that once a week with our members. All the shows that we do. We have a seasonality report, which I'm actually going to be working on today for April, just letting members know the stocks and areas of the market that tend to do well in April. We do our max pain, which we talk about around options. I mean, there's so much we do. Check it out. 30 days for free. If you use this button here, start your no-cost trial. You also can scroll down. We have a free newsletter, completely free, no credit card. Make sure you sign up with that email address, name and email. That's all you need to give us. Subscribe. We have tens of thousands of folks that have subscribed to our free newsletter. And why not? It's free. And it's education. It's free education. Sometimes there are trade candidates you can consider. But anyway, really important to check all that out and join us any way you can. Also, if you like our video, make sure you click the like button and subscribe to our channel. We do Saturday. We had a live stream. It was a free live stream. If you were subscribed and you had your notifications on, you'd have been notified the minute we went live. And you could join our, whenever we do these. We plan to do periodically these free live streams. I mean, we're building our community on the YouTube channel, the platform. You can help us, even if you're not a member of Earnings Beats, help us by clicking that like button and subscribing to our channel. But let's see what the market's doing to open. I did want to go through a little bit of all that. You can see we are starting to roll back over. I'm going to show you what this looks like on the five-day chart that I was showing earlier. So now all of a sudden, we still got this lower low, lower high thing. Well, not lower low yet, but lower high. Unless we can go back up and take out the end of the day highs yesterday, kind of keep this trend line going, I'm not going to feel very good about the market. And even if we do go to a new high, we need leadership from those aggressive areas. We need technology and consumer discretionary on the top, not in the bottom, not going up a little bit while everyone else, all the other sectors are going up a lot. That's just telling me there's no conviction. Those are the areas that would lead the market to the upside. If there's no conviction on rebounds in those groups, stay away. That would be my suggestion. All right, there's the diamond. Here's the spider. You can see the spider down near its low of the day right now, down $2.73. I mean, it could be that this thing just goes right back down and then just starts into this downtrend. If we extend this out maybe 10 days, you can kind of see we're still in this downtrend, even though yesterday was an up day. And now we're moving down close to the low of the day right now, 23 cents off the low of the day. What's QQQ doing? QQQ, basically same thing, moving down. It's down $2, 0.43%. IWM, down $2. It's down more than 1%. Look how fast small caps are moving back down again. That kind of stinks. But, hey, it is what it is. It's the market we got. We got to get through it. I believe we're going to be in a much better market later in the year. I don't know exactly when. I think it's going to depend on timing of certain things like the Fed moving back to cutting rates. If they're going to pause for a couple months and we got tariffs out there that are creating some uncertainty for the Fed and for a lot of traders, market doesn't like uncertainty. So we got to get past some of this. We got to figure out what the effects are. And if companies start reporting earnings and saying they can't forecast because of these uncertainties, and some of them did that back in 2018, 2019, they started pulling back guidance. Market doesn't want that uncertainty. They want to know what it looks like going forward. And so I think you got to stay on your toes here. I think you got to remain cautious. And for the most part, just kind of watch the action. I know a lot of you love to trade this back and forth, these highly volatile periods. I just don't think it's easy to trade. It's hard to guess from day to day what the market's going to do. If you can time it, and yesterday you knew that it was going to gap down and you nailed that, and then you knew it was going to rally all the way back and go green, and you knew, hey, you can make a lot of money. But if you're getting it wrong and you're chasing, if you're on the other side where you're always waiting for the market to do its thing and then you chase and then it reverses, things are not going to work out so well. Anyway, just be careful out there. We got a long time to invest in the market. Let's kind of be patient here while the market kind of does its thing. And we'll certainly have more opportunities to be more aggressive. Have a great day, everybody. Happy trading.